Well, joining us now to get across the open is Scott Phillips from the Motley Fool. Scott, happy Friday to you. Look, fairly quiet locally. Let's start in the States because a lot was hinging on that latest inflation read. What did you see out of that? Because obviously markets anticipating that rate cut next week.
Andrew, good morning. Yeah, mate, it is quiet, isn't it? After earnings season, the lull takes us all by surprise. We're a million miles an hour for a while, and all of a sudden you stop and go, what's going on? Big bit of news out of the US. Look, the market liked it because inflation was roughly what was expected. So that was the short-term issue. It doesn't seem to be enough to push the US Fed away from their stated intent to cut rates. So that's kind of, the market jumps on that kind of news, good as expected. Any fear or any concern that was in those numbers has now gone away. So you see that market rally on the back of that. The longer term question, I suppose, is what's on my mind, mate. It's way too early to draw a direct line between tariffs and inflation, but the jump in US inflation was the strongest monthly jump in quite a while, a couple of years. We really are now seeing a situation where if tariffs are going to cause price increases, I suspect they already are. As I said, it's too early to draw a straight line, and no one wins any prizes by arguing absolutely for these sort of things, other than it makes you feel better. The reality is it's probable that it's adding to those pressures, and we will see in coming months whether or not it remains an issue. The Fed will probably cut rates basically because they said they were going to, rather than because this data really gives them genuine room to. 0.4 for the month. I mean, it's 4.8 annualized. We shouldn't just annualize one 30-day period, of course, but the reality is the pressures are definitely to the upside on inflation. I wouldn't be cutting rates if I was the US Fed in that environment, but combination of political pressure and once you say you're going to do something, the intention or the preference not to so-called backflip may well keep them there. So good for their market overnight, probably good for our market here today. What it means, though, for their inflation, and what really concerns me is the Australian economy is looking okay, right? We're recovering. Things are growing nicely. GDP's up, spending's up. Not as good as we'd like it, but going in the right direction. If we are going to be dashed against the rocks, it's going to be the rocks of US inflation and or a recession that may well come. So a little bit nervous from that data. Not enough to push me off investing, of course, but economically, there are some clouds on the horizon.
Now, speaking of clouds, Oracle's cloud services. Look, I mean, this reinforced that the AI narrative is just continuing to gain momentum, isn't it? And, as a result, fairly narrow leadership. Nonetheless, we have seen all the major indices hit yet more record highs on Wall Street. What do you make out of that Oracle outlook and more broadly what you're seeing in AI at the moment?
It was extraordinary day and year for Oracle. It was up 45% this year before a 36% jump. It's astonishing. I've said to you before, mate, one of my tenets I live by, I'd always rather be the optimist in the room of pessimists than an optimist in the room of optimists. Because when everyone else is excited, that's when I kind of go, I'm not contrarian by nature, but I'm an optimist about the market in general. When everyone else is super optimistic, you do worry about prices a little bit. We've been recommending our members do more selling than buying recently, largely for that reason, not because we're making a market level call at all. But we're looking at companies we've previously recommended, done pretty well, so we're happy about it. But you look at the price and go, I don't think you can sustain that, right? So we've got a kind of a narrowing recommendation list just on that basis recently. And I guess that's by way of explaining, I don't know that a 36% jump is justified for Oracle. The reality is that any reasonable assessment of price should be a discounted future cash flows, right? It gets a bit boring on a Friday morning, but essentially what we're trying to do is say, what are the likely cash flows from here to eternity? Discounted back. A 36% jump on one number. I mean, man, maybe it is this good, maybe it's this good for this long, but a 36% jump on a 45% jump previously, that's a lot of hype and hope built in. I use both those words literally side by side because maybe it is good news and maybe it isn't hype and maybe it is hope and maybe it does happen. But the higher those prices go, the more that's built into those prices, particularly for some of those cloud companies, the more worried you need to be, I think. Again, not a prediction, just our job as investors to think probabilistically. And so the more the price goes up, the less upside room there literally is. And so you kind of have to start to think about, well, what has to happen for these things to be true? Now, I'm not an Oracle expert, mate. I can't suggest I have a very, very clear sense of the intrinsic value of Oracle shares, but you look at the way investors are throwing money at this stuff, and AI is going to be huge. I'm a huge AI bull as a feature, like the internet. I don't suspect, again, like the internet, lots of money are made by internet companies, but by the rest of us, companies and individuals using the internet, in this case using AI, to make ourselves more productive. So there will be money made by AI. There'll be a few standout winners, I'm sure. It does worry me the amount of money being thrown at these things. The amount of money, Richard Holden wrote an article on the Fin on the weekend, basically something like the money they're spending, something like the quarter of Australia's federal budget. It's just astronomical dollars. Maybe it pays off. Just know that as prices continue to rise, the risks continue to be elevated.
Interested, Scott, there you're saying you're doing more selling than buying at the moment. Can you give us an idea of what you're trimming at the moment?
Yeah, look, it's the overpriced stuff. So there's plenty of companies out there on really, really high PEs. We just look at that going, hey, what do you do with that sort of stuff? What do we do? Technology One recently, just too expensive to be able to sit with. There's been, I won't say recently, over the past sort of 6 or 8 weeks, and nothing in the last couple of days, and a lot of them are a bit old now. But that's kind of the approach we've taken, just trying to look at values independently of market expectation, market excitement, saying, hey, what's really sitting there? What can I kind of afford to walk away from? What's in the way? Just trying to find now my list. We sold Tyro Payments recently as well. That price simply just got too high with takeover speculation, so it's time to move out of that one. Moved a whole lot of stuff to hold. We sold RPM Global in the midst of a takeover offer. JB Hi-Fi we thought was too expensive, so we've recommended our members sell that as well. So there's a couple of examples. And again, these are great businesses. Technology One, JB Hi-Fi, they are fantastic companies. They're doing a really, really great job. What the prices infer about the required futures from here, again, it's possible. Of course, it's probability, not certainty, right? But probabilistically, from some of those PEs, you look at that and go, man, I can't in good faith say to our members, if you buy at today's prices, I think you will get a market-beating return, and that's our job. And if you can't do that, by the way, the other thing is there's a finite amount of capital out there, right? So you don't necessarily have to be right or wrong about just that. You want to put your money where the probability is highest for the best return. I don't think those companies are fit that bill.
Well, speaking of retailers, at least in the staples front and selling, Woolies offloading Big W. Yeah. Obviously, it's taken a bit of a hit in the share price. How are you seeing that?
Yeah, reportedly, I don't think they've announced it yet. If they have, I've missed it. But certainly plenty of reports that the company and the company's bankers, independently and together or separately, are looking basically to offload this. Talk about maybe Best and Less buys it, maybe it's private equity, maybe it's anchors that owns David Jones, maybe it's an overseas retailer. This is a really brutal space, mate. If I was Woolies, I'd absolutely be selling Big W. If you can do $4.1 billion in sales and still not be able to deliver a bottom line profit, tells you everything you need to know about how stupidly busy and difficult this industry is. The amount of capital tied up in that for a effectively negative return. It's always been the case, mate. I worked in and around the grocery sector my whole life before being an investor, and then I've watched it obviously closely since then. The reality is there's 3 big discount department stores, Kmart, Target, Big W. They've never, ever all been successful at the same time. It's one of those town's not big enough for the 3 of us kind of scenarios. Now, take that, add to the fact Dollarama has bought the Reject Shop, is going to rebrand it. Add to the fact that internet discounting, everything from Temu to Shine to Amazon to Kogan, I know Amazon and Kogan shares. There is so much alternative for cheap merchandise around the place. I don't know. You're brave. Well, it depends on the price, I suppose. I reckon you'd be a brave person buying Big W, hoping to fix it. I reckon Woolies would be very, very happy to have it off their hands if they can get a price they think is worthwhile. But I've got to say, other than there'll be a write down on the carrying value, perhaps, but from a cash basis, the longer you take to sell this, the more money you lose. I'd absolutely be getting rid of it as quickly as I possibly could and putting that capital to better use.
Yep. Just very quickly too, speaking of trimming, obviously the bank's looking at cutting costs. That obviously involves laying off, I should say, people, ANZ, NAB among them.
4,500 at ANZ between contractors and full-timers, 410 at NAB. Reports in the Fin this week that Westpac's looking to lay off round of about 1,500 people. If you can't grow your revenue, you want to grow profits, what do? You go straight for the cost line. That's what they're absolutely doing. They will close branches the very second they think they can get away with it politically. They can't at the moment. There must be reports on desks everywhere around corporate Australia on the amount of money that can be saved if they rationalise those branches. There's a community service question. I'm not talking to that one right now, just purely financially. They are huge cost sinks. We'll see more of it, mate. We just talked about cloud and AI. AI is coming for all of us in different ways. Back office, banking, finance, some of that stuff, AI is going to absolutely do it. And a reminder too, by the way, NAB's CEO said, I think it was last week, AI is not going to take your job. Someone else using AI is going to take your job. And that's exactly the right framing, right? It just means we can do more with less or more with the same, or frankly, the same with less. That's what the banks are assuming, that they can do exactly what they're doing now, but with fewer people. ANZ also going to cut back on some product lines, which is fascinating. I'm looking forward to seeing how they do that. But yeah, plenty of stuff going on in corporate Australia. This is not the last time we'll talk about redundancies in banks. Probably not the last time across the rest of the market either. It's going to be a rocky time when AI gets introduced. I am a bit concerned about the medium-term impact on unemployment in particular, maybe even economic growth, depending on how that rolls out. Long-term, it's going to be brilliant. Medium-term, we've got some work to do.